everyone, and welcome to one of our knowledge transfer sessions. Today we're going to be talking about a really good topic, Roth Conversions. Something the average person should be doing every once in a while, but I think there's some nuance in math here we need to go over. So let's go over Roth Conversions, kind of a quick A to Z. Once again, the information we're going to go over today is going to need to be treated as general in nature. Not every person's situation is going to be different, especially when it's going to be the same, especially when we talk about Roth conversions. Oftentimes there's lots of differences, and so I'm going to try and give you good information, but just let's treat this as general in nature today. My name is John Erickson. I have a financial planning practice next to Overlake Hospital in Bellevue, Washington State. I have more than 17 years experience in the financial services industry, and I love creating these videos and trying to spread knowledge out there. I think that's a really good way to advance people's capabilities in the financial services industry. Today we're going to be talking about Roth conversions. And so before we even talk about Roth conversions, we need to talk about what is a Roth conversion. And then we need to understand some basic math. And then we need a deeper dive and talk about some quality of life questions. Because, the math around Roth conversions is pretty good, but there's more nuance to it than I think you get in a lot of news articles or articles you see online. So, basic question, what is a Roth conversion? Let's make sure we're all on the same page here. So, usually, historically, most people when they're saving for retirement are saving their money into qualified accounts, such as IRAs, 401ks, or 403bs via deferrals. Okay? And what deferral means is that you didn't pay taxes when you put the money in there, so you have to ignore the tax man. But when you take the money out, it's taxable to you at your income tax rate. Okay? And so if you were to put this money in and you were in a 22% tax bracket, you wouldn't pay the taxes up front. So if you invested $100, you wouldn't have any reduction on that $100. But when you take the money out someday, you're going to pay 22% in taxes and you'll net $78. Now, a Roth account works a little differently. A Roth account, you had to pay the taxes up front. And so if you put $100 in a Roth account, you would actually have more than if you put it in a deferred account. But with a Roth account, you did have to pay taxes behind the scenes one way or the other. And so technically, if you really do the math and look at it based upon your tax brackets, if you did the equivalent math for your 22% tax bracket, you'd put $78 in because you're paying 22% in taxes somewhere. And then when you draw the money someday, you don't have to pay the tax anymore. It is now tax-free on the back end. And that's pretty strong for a lot of reasons. Now, what happens in a Roth conversion is you're allowed to take out a certain amount of money from your deferred qualified accounts, like an IRA. In this case, we have $100,000. You're going to pay taxes on that money at your tax bracket. You're going to mark a box on a withdrawal form saying it's a Roth conversion, so the IRS knows that what's going on here. And then you're going to convert it to a Roth account and make it non-taxable forever, okay? Or non-income taxable. There's other taxation issues to always worry about, but the big one, the income tax one, it's going to make it basically non-taxable forever unless Congress changes laws. And that's a basic concept of a Roth conversion. And the question always comes into play, should you do this or not? And I'll tell you that the majority of people should be doing it a little bit all the time. It's actually, if you're really attacking your tax brackets, it's a good, well-rounded strategy to do Roth conversions. But there's a basic math problem, I think, with Roth conversions. Right here, one of the basic problems you can run into is if you do the math and you keep your tax rates the same on both ends of the equation. When you first made the choice to put the money in and when you took the money out someday, if your tax rate is the exact same in both sides of the equation, it doesn't matter if you do a Roth conversion or not because you have the same end result. In fact, I would argue a Roth conversion is worse in this scenario because you had to do work for a different end result, or for the exact same end result. And so what you're going to notice here is your tax rate really matters to this question. And, on the next slide here, and what I'll point out is that when you have the 25% tax bracket, like you see right here, and you had your choice of getting what we call a tax arbitrage, okay, where you get to put the money in at a certain tax rate and then take it out later at a different tax rate, you're going to find that Roth conversions can oftentimes make a lot of sense. So in this example here, you have a 22% tax rate. If you did a Roth conversion and taxes went up in the future, like they could in 2026, as an example, you would save roughly $7,000 doing the Roth conversion in this example right here. And so that's the power of a Roth conversion. It's taking advantage of certain tax situations and avoiding worse tax situations later on. And some people can really take big time advantage of this basic math right here. But the thing to always remember is this is about making a guess around your overall tax situation, because your tax rates is the overall situation here. And retirees, for instance, oftentimes have peaks and valleys around their taxes where they can take more advantage of Roth conversions than someone in their working years. Now, overall, you probably aren't hurting yourself doing moderate Roth conversions. If you convert all your money at one time, that could be a problem. But if you're doing moderate conversions, even if it's not optimal, you're probably not hurting yourself. And then overall wealth matters here a lot. The wealthier you are, the more likely you should be doing Roth conversions, because there's lots of middle class tax breaks that are based upon some fairly complicated math. And the more wealth you have, the more likely you're just not getting those anyway. And that means that the Roth conversion math is much simpler and more likely that it's going to be to your benefit. All right, so that's the basics of a Roth conversion. You're going to take some money out, you're going to pay some taxes, and you're going to make it non-taxable forever. And depending upon how you look at the tax situation, that could be a good idea or a bad idea. So let's go over some basic rules of thumb around Roth conversions. If you think taxes will go up in the future, a Roth conversion almost always makes sense. Now, I usually suggest don't do it all at once. But, in the example I just used in the previous slides, I had 22% tax rates going to 25% tax rates. And I knew there was a reason for that, is because in 2026, we have some tax cuts expiring that would make sense to consider looking at this. And the other thing too is that, if you look at it, to go from 22% to 24% tax rates, you need to take out more than $100,000 for the average retiree couple, because I find the average retiree couple lives on around 100 to 120 a year in retirement. They can take out almost $100,000 and pay 22% in taxes. They probably will never have a better tax situation than that. Their kids often won't have a better tax situation than that. And that's a good spot also to consider doing a Roth conversion. But, the idea that federal taxes are going to go up big time in the future, there's a difference between expanding the tax base and actually raising taxes on current tax bases. And what I would argue is that if you look at it historically, federal tax brackets have decreased for the wealthy and stayed fairly similar for the people who are more middle class. So if you're expecting like a big tax increase in the future, congressionally, I don't know if that's going to occur, because historically it's actually been the opposite. And then for retirees, there's another complex math problem, and it's all around Social Security, and I'll also add Medicare IRMA in there. Social Security and Medicare IRMA are secondary tax calculations, and there are very specific tax breaks for retirees in there. And when you do Roth conversions, you may have a situation where you're paying a 12% income tax on the Roth conversion, but because of those other situations, Social Security tax breaks and Medicare IRMA, you actually lose some of those tax breaks on the Roth conversion. You pay more taxes on that, and we'll talk about that. And you should be comfortable looking at the chart on the right, and this is the 2024 tax brackets. And basically what you're doing is you're looking at your tax bracket, and you're tactically figuring out where you can save money on taxes. And your automatic sweet spots are the 10 to 12% brackets. If you're in the 10 to 12% bracket, you almost always want to do Roth conversions up to 22. At 22%, it's a little bit more elective because you may not be really helping yourself. There's this theory that in retirement, people can't really alter their tax brackets too much, even when you get to required minimum distributions. You'll see you're paying more taxes, but you don't always alter your tax brackets. Now remember, that's a statistical thing I'm saying. An individual situation will be different, but as a group, we don't often alter our tax brackets too much in retirement. And so because of that, when I say that 22% is more elective, what I mean there is that it's probably going to help your kids a little bit more if you do Roth conversions to 22%. It can protect against a couple other scenarios we'll talk about, but it's not going to do a ton for you personally. All right, now Social Security is a big challenge, and I actually need to use a tax spreadsheet to calculate this, and I just calculated this the other day for someone. And so that's why I'm using a similar example on the screen right here. So this person had Social Security, pension, and an IRA withdrawal already this year. And they were in the 12% tax bracket currently. If I did a $30,000 Roth conversion for this person, would they pay 12% on that $30,000? Right. If you do the math, it should be in theory they would pay 12% on that $30,000. But the reality for this couple is that because the way Social Security is taxed, only half of their Social Security was currently taxed in the original scenario. When I added a $30,000 Roth conversion, what happened is now Social Security was 85% taxable. And they were actually averaging closer to 17% taxes than the 12 they were expecting. Now, it's still not a terrible idea to do the Roth conversion here. You are actually probably materially putting yourself in a better position. But if you look at someone's math, someone's life expectancy and dribbling the money out over their lifetime, if you're trying to spend your money on yourself and you're running into this exact same situation right here, it's actually probably better not to do the Roth conversion, because even though 17% is not a terrible rate, you're probably going to be over your lifetime paying closer to that 12% number because you're not breaking the Social Security tax breaks. And so if you just continue to take out your normal amounts over your lifetime and didn't do the Roth conversion, you probably would have paid overall for yourself less in taxes. Your heirs are a different story, but for yourself, it actually probably made sense in this one person scenario not to do the Roth conversion. But it's not that big a deal on either side of the equation. It's not that much tax savings either way. Now, the other problem with reason why you might want to do Roth conversions is having different types of tax buckets. So retirement, especially, people will have splurge events. They'll buy that RV, they'll take big vacations, while at the same time their kids happen to get married, and dang it, the roof is leaking. Splurge events are pretty common to happen once or twice in retirement, where you take out a whole bunch of money at once. And the problem is that in splurge events, it can pop your tax brackets up. And so when we're comfortable with the chart on the right, if you could take out, even do Roth conversions for 22% and just create a $100,000 bucket of Roth accounts, every once in a while when these splurge events occur, you can tap into that account and keep your overall tax situation lower. That's a reason why you probably want to tactically do some Roth conversions and save some money for yourself, but not do it all, because doing it all can be problematic. Now, required minimum distributions. There's something that hits everyone later in retirement, almost everyone, and required is in the name. And so you're forced to take money out, and your solution here is going to be calculate your future tax rates, because sometimes you're going to see that you're in a current tax bracket, say 12% right now, and in the future you might be 22% when you're doing required minimum distributions, and you can't even avoid that later on. So you actually probably want to do Roth conversions even more aggressively earlier, even in the 22% bracket in this scenario, because you know you're going to be in 22% the second the government makes you take it out. Required is in the name, required minimum distributions. And it might protect you from other things like Medicare IRMA, and it creates a better overall estate for your kids if that's a concern. So really you want to look at doing your Roth conversions. And Medicare IRMA is an advanced thing, because Medicare IRMA is another one of those calculations where it looks at your income and you get to pay bonus taxes based upon your income under your Medicare Part B and Medicare Part D. So, when we look at life events and we look at required minimum distributions, when they hit someday, they could be not problematic, but they do create some taxation issues. And if you could have done some earlier Roth conversions, that's really cool. Estate planning. The other thing about Roth conversions is it makes the money that would be very tough to handle in estate much easier. So when someone inherits your IRAs or 401ks and things of that nature, you will notice that if it's not your spouse, they have to take the money out within 10 years. Okay, and usually you're going to spread it out actually over 10 years to avoid major tax hits. But you got to take it out over 10 years. Sometimes people just take it all at once. We might all have that kid. I'm hoping my kid's not that way, but you never know, right? And your heir's going to pay that money on their tax rates, not on yours. So, if a state is part of your situation, you're like, well, Roth conversions, I don't know, maybe yes or no. The ability for your heirs to get the money tax-free is usually a pretty strong indicator that a Roth conversion is a good idea. But I would argue there's a problem with doing too much in Roth conversions. And And the problem is some of the deductions you can get later on in life, and specifically the medical expense deduction. A lot of retirees will have an end-of-life event where they have significant medical expenses, and it's usually pseudo long-term care for a period of years. So it's not the skilled care you're getting from things that are covered by Medicare. It's usually like a long-term care event where you're going to want to deduct significant amounts of money, and we're talking hundreds of thousands of dollars under the medical expenses deduction. And that's pretty strong mathematically. The medical expenses deduction is great if you fall into this scenario when you get to itemize. And that allows you to take money out of your IRAs functionally tax-free at that point, once you get past the AGI standpoint. So this is one of the reasons why you may not want to do tons of Roth conversions. So let's do some basic final thoughts. So always look for opportunities every year, but at the end of the year. Okay, you want to do your math. I have a big rule in retirement. I want to get you to spend your money. You can control your own destiny, but it always worries me that people worry so much about not paying taxes that they don't spend money on things they want in retirement, right? So I'm always trying to get you to spend your money throughout the year. But if you get to the end of the year, you're like, I got this extra space. Let's look at Roth conversion. Use your own specific situation. And I would argue that a standard Roth conversion amount is somewhere between $10,000 and $100,000, depending upon someone's situation. Are you going to pay higher tax in the future? It's one of the biggest. That's what's going to make the math sing. If you're not going to pay higher taxes in the future, it's a much more elective choice. It's not going to do a lot for you, and in fact, it might conflict with the medical deduction. Your heirs are important here. If you want to leave money to your kids, Roth conversions are usually a great way to do this. Is the extra worth it to you? In one example I showed earlier, I showed a $100,000 Roth conversion that saved you about $7,000 of taxes over 10 years. Once you spent it, the thing about you spending it is you got to spend it. And if you don't actually withdraw that money and spend it, you may never actually get that benefit. Your heirs might. You might get it on paper, like emotionally, you might feel good about it. But you don't ever spend it and you die with that money. Did you really get the benefit for the work you did? Which is why I always try and get you to spend your money. I like Roth bucks to be created and funded over time, but I like this to be mathematically derived and not based on your own situation. You consistently look on a year-by-year basis at the end of the year, and we don't necessarily do it all in one big fell swoop. So once again, we're here to help. If you ever have questions about Roth conversions, if you want to have someone do the math for you and walk you through it, totally happy to do that. My practice is next to Overlake Hospital here in Bellevue, Washington State. I work with my clients in person or virtually. But I hope that at least today gave you a basic overview of Roth conversions and that you found this information helpful. Thank you.